Good morning and welcome back, friends. In my morning video, when I was reviewing the US markets, I mentioned that as we go a little further into the morning session, say between 10:30 and 11:30, we could see a fall in the US markets. You have seen a good fall in this time period. Friends, I will just explain what is causing this fall, but I gave those timings and then I mentioned later on as well, after 12 and 2 o'clock, you may see some more fall. Now, and this is exactly what has happened. Do join our Prime or Prime Plus Telegram groups. We'll give you daily review before the markets open as what are the time, what is the nature of the day, whether there'll be a rise, fall, the timings, and how the rest of the week will span out, how the weeks ahead and the months ahead are expected to span in terms of the market movements. There is a great structural shift that is taking place in the US markets, and I would love that you should enjoy it, provided you act with good financial discipline. So would love to share all this with you to get and to be a part of our Prime or Prime Plus Telegram groups. Do WhatsApp us on 982-086-1044. Alternatively, you can email us at globalmoneyinvestor@gmail.com. Now, coming back to what's causing this fall today. McDonald's reported a drop in sales during yesterday's earnings call. It looks like the post-pandemic surge in restaurant revenge eating has come to an end. But fast food investors can be assured the unhedged continues to eat more than its share of burgers and fries. This afternoon, Microsoft reports its earnings. Tomorrow, Meta follows, and we have Apple and Amazon coming in on Thursday. That's a fifth of the market capitalization of the S&P 500, figure that probably understates the four companies' importance to the overall market. They, along with Alphabet, which reported last week, and Nvidia, which reports in a month's time, have provided most of the gains in the market over the past few years, and therefore they have been watched with great attention. And if their outlooks disappoint, then there is going to be great amount of trouble. And for some reason, I believe in some ways or the other, trouble is lurking in the background. Let me explain further. The sensitivity of these shares to less than thrilling results was demonstrated by Alphabet last week, which reported a 14% revenue growth and earnings slightly ahead of estimates. Its shares fell 5% the next day. However, this could be down to all of the platform companies being caught in a downdraft in recent weeks. To the degree that these declines represent an orderly reduction in expectations and a rotation away from the big tech, it is good news for the market overall. To see the Russell 2000, I'm sure makes you happy, as it does make me happy as well. It shows that the breadth of the market is increasing, is improving, and that should give you a degree of comfort. Too much had been riding on just a few stocks, but expectations remain dangerously high. Here are, a few things that you should note. One, Apple and Microsoft are now trading at hefty premiums compared to their longer-term average price to earnings valuations. And for the past 5 years, those valuations have already been consistently high. Not so for Alphabet and Meta, probably because their earnings are dependent on advertising and thus they are more economically sensitive. Amazon is a special case in that for a long time it was considered to be under-earning relative to its potential, justifying a high price-earning ratio. Okay, that seems to be less true recently. Okay, I repeat, Amazon is a special case in that for a long time it was considered to be under-earning relative to its potential, justifying a higher price-earnings ratio. This is in the big tech basket that I'm referring and focusing my attention on. B, all of these companies except Apple have performed extremely well in the past couple of years, both in terms of price appreciation and revenue and earnings growth. Apple's growth has been notably slower than the rest. Point number 3, However, we have just got the Apple Intelligence come out yesterday in a beta format to be given to the developers for further testing. And that, I believe, could be a good sign of things to come. That could bring about great improvement in Apple's iPhones. And who would not love to have artificial intelligence being baked in its own iPhone? Would you not like to call or have Siri call the person you desire at a moment's notice? Or you have Siri make an email and shoot it to the person you desire? The crucial point, as you can see from the analysts' consensus estimates for revenue and earnings per share, the market thinks that there will be no slowdown in growth. Double-digit revenue growth and earnings growth at or about 20% for years to come is a hurdle that these companies must jump. Apple is again the exception, but notice that even the expectations there are for accelerating results, especially post the Apple Intelligence announced yesterday. Unhedged things, therefore we can say that these are all awesome companies and that the most likely outcome is that they will meet these expectations. Okay. My point is that their star status is already baked in the cake and that any serious misstep will overturn a lot of furniture throughout the markets. There's another risk as well. These companies have done much to support the market's artificial intelligence narrative by making big commitments for increasing capital spending in support of AI services, including Apple. Microsoft has said that we expect capital expenditures to increase materially this year and that near-term AI demand is a bit higher than our available capacity. Amazon says that strong demand for cloud services and AI means that it will meaningfully increase capital expenditures. Meta says that AI is driving higher investment both this year and into 2025 as well. If these companies walk back their commitments, even in the most gentle and qualified ways, impact will be immediately felt by Nvidia and other chip stocks, which have been the other, and I would say even more important, crucial support for the markets. This is about as big a tail risk as investors in the US stock market face right now. Last week, a rapid strengthening of the Japanese yen coincided with a surprising weakness in US tech stocks. Now, there's a Wall Street speculation. Were the two connected in any way? The theory goes as follows. The yen is a common borrowing currency for a carry trade in which the investors borrow the currency of a country with low interest rates, such as the Japanese yen in this case, and invest the proceeds in a higher yielding market elsewhere. Shorting the yen has been a popular strategy in recent months. So when the yen suddenly appreciated last week, triggered by a yen intervention by the Japanese Ministry of Finance and reassuring inflation news in the United States, both the carry trade and the yen shorts unwound their positions, forcing investors either to sell off the tech equities they had bought with borrowed yen or to sell tech equities to cover their short positions. But there is no hard evidence of investors borrowing yen to buy tech stocks or selling tech stocks to cover short positions. Is this evidence very much on the wall, written on the wall? Or are we reading between the lines? The carry trade did start to unwind last week. We saw the Mexican peso, the US dollar, and other Latin American currencies weaken as investors got out of some common yen to higher interest currency carry trades. Okay, some would argue that the leveraged tech equity positions were funded through the yen, and that is what has probably caused this trade to reverse. There could be more global reverberations and more wild theories of what is going on when the Bank of Japan meets Wednesday. They are on par with the US Federal Reserve. First, the dollar's recent gains over the yen have been caused by the big gap between the US and the Japanese interest rates. The BOJ hopes to start a gradual rate rising cycle, but will only do so when they are confident that the wage-induced inflation is entrenched. June's Tankan, which is the BOJ survey of businesses, suggests that wage inflation was indeed starting to catch on. The BOJ could therefore raise rates as soon as Wednesday, and that could catch the markets by surprise. While the BOJ is not expected to increase its rate by more than 0.25%, a gradual raising cycle would usher in a stronger yen and could mark the beginning of the end of the dollar-yen carry trade. While the trade will still be functional until the rates fully converge, traders may look to other currencies or may be scared off by the yen volatility. History has shown that yen volatility indeed hits the markets. Next, the BOJ has signaled that it will end the yield curve around yield curve control, the YCC, a quantitative easing program started in 2016 in which the BOJ buys nearly 6 trillion yen worth of Japanese government bonds per month to keep the yields close to zero. The BOJ Monetary Policy Committee is expected to announce a plan for reducing the rate of purchases. Many analysts expect an initial 50% reduction in the JGB purchases. The BOJ's huge bond purchases resulted in an institutional capital flight from Japan towards foreign equities and bonds, which may have helped pump up the US asset valuations over the past 10 years. Some fear that there could be a fearful reversal of the SAR that allegedly occurred last week. More seems to be in the offing. Stay tuned and do join our Prime or Prime Plus groups addressed to the global financial markets and the US markets in particular. You can join them by WhatsApping us on 982-086-1044. It's going to be a fun week ahead, and there are many negative periods I see lie ahead of us. Happy investing. You can WhatsApp us on 982-086-1044. Alternatively, you can email us at globalmoneyinvestor@gmail.com. Happy investing and have a great day ahead. Take care. Bye-bye.